Hello, and thank you for taking this intro continuing ed course. My name is Alan Jady. I'm a tax lawyer with the firm of Anderson and Jady in Littleton, Colorado, a suburb of Denver. Today we are going to introduce you to the basics, some features, and benefits of advised PPVUL. So today we're going to be talking about what's advised PPVUL. You'll receive a 30-second elevator speech so that you can talk fluently as to what it really is about. The numbers also tell the story here, so we'll be going through an illustration. I just used an example of a person, actually me, in terms of age and health and a given amount of investment in a policy. We'll also be talking about the differences between private placement life insurance and traditional insurance, and there's a huge difference in what it's about, why we believe for the right circumstances PPVUL is a much better product. And once you understand the concepts of advised PPVUL, then the floodgates can open up as to traditional advantages to use it for traditional estate planning and to enhance traditional estate planning. It's things enhance the advantages of rolling grats and possibly even private split dollar and loans and policy loans and interest rates, etc., etc. We'll be talking a lot about that. And lastly, how can this help you? How can this be an improvement to your practice? And how can advised PPVUL be a practice development tool? Lastly, why are we doing this? Why are we offering this course for free? Essentially, our goals into why we are doing this is to help you gain knowledge, so that you'll be willing to invest more time to learn and to evaluate whether this can be a practice development tool for you and whether this makes sense for you and your practice. And eventually, we'd like you to add advised PPVUL to your toolbox, so when you're meeting with clients, you can talk to them and bring it out and suggest that they at least consider it. So that's our goals. Maybe a bit selfish, but that's our goals for putting on this course. So sit back and we'll move on to the 30-second elevator speech. Essentially, advised PPVUL is an investment-oriented life insurance contract as compared to death benefit-oriented, meaning that, of course, there's death benefit with advised PPVUL, but the focus is rather on maximizing the cash value of the policy after tax as compared to maximizing the death benefit. The difference is not as dramatic in the early years, but it's huge in the later years, particularly age 70 on up. Because of the much higher death benefit, the internal costs of the policy in relation to the cash value are so expensive that the cash value begins to erode with the traditional insurance. However, with private placement, the death benefit is typically a narrow corridor margin above the cash value. And for example, at age 75, if the cash value is $1 million, the total death benefit is $1,050,000, 5% above cash value. Huge difference in terms of cost, huge difference in terms of lapsation, huge difference in terms of investment oriented and the overall goal of growth accumulation and wealth transfer and wealth shifting. The private placement VUL is very efficient. It must be for it to be an investment tool. That equates to low ongoing costs, approximately 1.25% of cash value or less per year. It also equates to the other side of the equation is not only are costs lower, but the investment performance must be better than traditional life insurance. And the combination of the two in terms of lower costs but better investment results is dramatic. Lastly, we don't want any clients who don't wish to be there to stay. So there's no surrender fee to get out. I like that for clients. They can evaluate something, and after a year or two or a month or two, they can surrender the product, and there's no surrender fee. So on top of the low ongoing costs annually, there's also very low setup costs, very low policy fees, design fees, so that most all the premium that is paid results in being cash value, which also results in being surrender value. Another basic and crucial element of private placement VUL is asset protection. PPVUL has 3 levels of protection. There's segregated accounts, which means that each insurance policy stands on its own and is walled off from the creditors of the insurance company or from the other policy holders in terms of being able to access the cash value of the segregated account. Crucial importance. Bermuda has one of the better segregated account legislations, in my opinion, in the world. Statutory protection. Bermuda also, as to Bermuda Life Insurance Trust, provides an exemption from creditors such that creditors of the insured cannot access the policy values, cash value of the account for a policy issued in Bermuda and for a policy owned, in my opinion, by a trust, an islet that also has as a co-trustee at least a Bermuda trustee. Also, we get asset protection via retitling. We overlook that sometimes, but actually transferring assets into an irrevocable life insurance trust is in itself has been retitling and is transferred out of the client who has greater risk in terms of retitling. And lastly, advised PPVUL has many living benefits. It's income tax-free buildup of cash value. It's tax-free so that the growth is not taxed. So if the cash value increases from 10 to 15, no one pays tax on that growth. Powerful tool and powerful feature of life insurance in general. Assuming the policy is designed as a non-MEC, then withdrawals from the policy can occur that are tax-free to the extent of premium, and thereafter there are loans that can be made that are also tax-free upon receipt. And the loan balance then, if not repaid, is subtracted from the death benefit on death. The second aspect of this is the numbers tell the story. Here we have an illustration that I have